I'm going to do another economics video. A lot of people have been asking me, Adam, we like when you do an economics video, just talk about the economics, micro, macro, real estate, cryptocurrency, stocks, the Federal Reserve, and show you guys a bunch of charts. So I thought today would be a great day because we actually have a triple whammy of misses. We have 3 huge misses, and this is very, very, very bad. Very, very, very bad. All right, guys, this is the PCE report, okay? The PCE report came out today. They give us a bunch of numbers. The PCE report came in 0.6% for the month, and it came in 4.7% year over year. We were expecting 0.5%. They gave us 0.6%. The expectations was 0.5%. We ended up coming in at 4.7%, and we were actually expecting 4.4%. One major thing that I wanted to show you guys right here, the only good thing is it says that the personal savings as a percentage of disposable personal income was 4.7%. So it seems like people are starting to save more money, which is really, really good. This is the number you want to look at. 312 billion increase in current dollar PCE in January, reflecting an increase of 162 billion in spending for goods and 150 billion in spending for services. Guys, that's absolutely ridiculous. All you need to remember is this. You don't even have to look at the numbers. We were expecting to get a 0.5. We were expecting to get 4.4 year over year. We got 4.7 year over year. We got 0.6 for the month, which means that we missed. What is this telling you? And this is the preferred method that the Federal Reserve likes to look at. It's telling you that we missed the numbers, which means Jerome Powell and the Federal Reserve are going to get together, and the chances of them raising the interest rates is higher. We thought for the longest time that they're going to be lowering the interest rates or staying steady at 25 basis points. The chances of them raising it 50 basis points actually went from almost nothing to around 35%. I'll show you the chart in just a moment. This is the PPI report. The PPI report, we actually got 0.7%, and we were expecting 0.4%. And the PPI is the producer price index. Think about like the inflation for wholesalers. And core PPI actually went up 0.5%, and we were expecting 3%. So now we have the PCE that went up more than expected. We have the PPI that went up more than expected. And the PPI is usually a precursor for the next CPI report. And then the CPI report that we actually got, we actually ended up getting 0.5. We were expecting 0.4, right? We got 0.5. We were expecting 0.4. We were expecting 6.2. We actually got 6.4. For core, we actually got 0.4, and we were expecting 0.3. And for core, we ended up getting 5.6 when we were expecting 5.5. What is the Federal Reserve basing all of their decisions on? Is inflation going up or is inflation going down? For the longest time, inflation started to go up and then it started to go down, right? And we were thinking that inflation is starting to be under control. Everybody thought this, and for good reason. Not to mention, they moved the goal line. The way that they measure CPI is different than the way that they were measuring it before. And the CPI that came in 6.4, if you were to measure it the same way that you measured it before, would be 6.7 instead of 6.4. So keep that in mind. Even with changing the rule set, we still got inflation. The Federal Reserve is going to be looking, is inflation going down to 2% or not? And unemployment. Unemployment is at all-time lows again, like 3.5%, 3.6%, something like that. Because unemployment is record lows and inflation is not going down anymore, but it's going to start. So inflation went like this, and now it's starting to go like this. It's starting to creep up, right? Not to be worried yet, but it's starting to creep up. Because inflation is starting to creep up, the Federal Reserve now needs to make a decision in their next meeting. Before the next meeting, there's going to be another CPI, there's going to be another PPI, and I believe there's going to be another PCE, or I might be mistaken. So they're going to get more information, but it's not looking good. It's definitely not looking good. So now check out this chart right here. This is the CME Fed Watch. There's a 65% chance, 64% chance that they're going to be raising by 25 basis points. All of a sudden, there's a 35% chance that they're going to be raising by 50 basis points. Current rate is 4.5 to 4.75. 64% chance that they're going to raise 475 to 5, and 35% chance that they're going to be raising 5 to 525. The Federal Reserve very, very, very much needed to be raising by 25 basis points in order for them to max out at that 5.1% rate that they're trying to get to 2023. The rate that they're trying to get in the next meeting in March, Jerome Powell says that they're going to give new forward guidance. What is forward guidance? Every meeting or whenever they feel like it in the meetings, they say, hey, we're trying to raise the federal funds rate to a certain percent. And that federal funds rate percent was supposed to be 5.1% in 2023, 5.1%. Obviously now, if they're going to be raising by 50 basis points or maybe even higher, they're going to increase it. For a while, we thought that they were actually going to decrease the number. But now they're not going to be decreasing the number. They are most certainly going to be increasing the number in the next Federal Reserve meeting, which is going to be in March. Now let's think about it, the broader market. If the market started rallying because the interest rate, they thought Federal Reserve is not going to be raising interest rates as aggressively, they're going to stay at 25 basis points. Maybe they were going to lower it. And all of a sudden now, inflation is going up, unemployment is still down, and Federal Reserve needs to do something so that they can save the work that they did, because inflation was going down for quite a while. As soon as they're going to announce in March that they're going to be raising the interest rates by possibly 50, but more importantly, the forward guidance that they're going to be raising it from 5.1 to 5.3, 5.4, even 5.2, whatever. The second they're going to say that, the entire market is going to, they're going to cause a panic. The only thing that's going to save us from that is the next CPI report, the next PPI report, if they actually come in better than expected. Is that going to happen? Probably not. Because as I said, the PPI is a precursor for the CPI. And if the PPI is a precursor to the CPI, and the PPI actually did worse than expected, we ended up getting 0.7 when we were expecting 0.5, then you could assume that the CPI is also going to come in hotter than expected. And remember, these are with the new rules. So although most of the public, so 95% of the public, 99% of the public don't even know that they changed the rules, they know. So the Federal Reserve knows that they changed the rules, and inflation is still high, which means that they're probably going to say we're going to raise the interest rates. I saw a comment, Gabe said that they're going to say 6%. If they say 6%, guys, everything's collapsing. So the slide's going to keep going. I'm going to go into debt right now. Be careful. Don't just go blow your load. Don't go start investing. Look for deals. When Palantir went through the roof, everybody started buying. But when things are going down, nobody's buying. Have money on the sidelines. A while ago, I sold out of a lot of positions. You guys know this. I was super transparent. And I was very reluctant to buy into stocks. I nibbled here and there. Google, I started buying a little bit. And then I told people, I'm not going to just blow my load. I'm going to wait until Google hits a 52-week low to keep buying more. Be very careful with your investments right now, because the market sentiment is going to shift. Now, most people are not going to realize this. Do you remember when the CPI came in and it came in hot and the market still had a green day? The market basically brushed it off their shoulders and they're like, yo, this is an anomaly. It's not going to be like this. Well, it is like this. It's a freaking very big rude awakening. CPI, PCE, PPI, all up. Inflation going up. Real inflation in the stores. Did you guys buy eggs lately? It's fucking expensive. And unemployment is down. What does that mean? The Fed is very scared to cause a deep recession. So we had a technical recession, but everyone's petrified of a deep recession, like an actual recession. And we are on the brink of a very heavy recession. That's why you better have cash on the sides. I sold my real estate property in Jersey so that I can have cash on the side to scoop up real estate, stocks, crypto, if the market completely collapsed. Now, I don't know what happens. And for a while, the inflation started going down. Even Gabe, he had options, and he said that if these last reports come out better than expected, he might have to sell his options at a loss. He ended up keeping them. I'm sure he's going to be making money. And what I'm buying is I bought a reverse NVIDIA play. So I'm shorting NVIDIA. I'm also going to buy a reverse SPY play where I'm shorting the SPY. Whatever you guys want to do is up to you. Let me show you some more charts so you guys understand what I'm talking about. This is from the Federal Reserve Bank of New York. This is for Q4 of 2022. Mind you, this is a lagging indicator, guys. This is a lagging indicator. Why is it a lagging indicator? Because we're already in Q1 of 2023. Almost done with actually Q1. So household debt rises to 16.9 trillion. This is not just debt on credit cards and loans. This is your debt for your house as well. I'll break it down. This is the scariest part right here, which I'll show you in just a moment. The household debt rose by 394 billion or 2.4% to 16.9 trillion. I'm not so concerned about that because most of this is from real estate, but this is where you better be concerned. Credit card balances increased $61 billion to 986 billion. When I did the live last time, that number was 950 billion. When I started doing the lives, that number was like 930 billion, 920 billion. That means we have record debt. Since the Fed started tracking debt, this is a record, and it's about to hit $1 trillion for the first time ever. This surpassed the pre-pandemic high of 927 billion. So before the pandemic, we hit 927 billion. So it went like this. The pandemic hit. This was our debt. It went to like 600 billion or something like this. And now it's going through the freaking roof. Think about it. What happens during the pandemic? A recession. People stop spending money. Artificial, natural, whatever you want to call it. It was a recession. That's what happens when you have a recession. People stop spending money. That's why a recession brings inflation down, because as you stop spending money, naturally the price point of your goods and services goes down as well. That's why Federal Reserve wants more unemployment. I know what I just said contradicts what I said before. Hey, they want employment. Employment hinders them from bringing prices down. They actually want people out of work so that they can't afford anymore to spend on credit cards. They can't afford to go out. And because they do this, the price of everything starts cooling down. Raising the interest rates could only do so much. At one point, you need a collapse. Mortgage balances rose by 11.92 trillion and auto loan balances 1.55 trillion. You remember when I say all the time that the most assets somebody has is in real estate? This is what I was talking about. So even though credit card debt, right, personal debt is near 1 trillion, it's only a fraction of the total debt when it comes to real estate. So then think about this. If the Federal Reserve, it's all a chain reaction. Let's think outside. It's all a chain reaction. If the Federal Reserve needs to raise interest rates, and if they raise interest rates, then mortgage rates go up. And if mortgage rates go up, what does this affect? It affects the housing market. If most people have their money tied in to the housing market via mortgages, they have a certain amount of equity in the housing market. As you raise interest rates for mortgages, people can afford less of the same real estate. If people can afford less of something, that something price must go down. Fair market value of the price moves. If you're paying this much, the price is this much. But if people all of a sudden could only pay this much, eventually, the price will go down here. And I have some charts for real estate. When the price of real estate is going to go down, guess what's going to happen? Most Americans have their money in real estate. So now Americans have record high debt, And their main source of equity, right? Equity outside of savings account, like actual equity, is in real estate. So record high debts and real estate is going to go down. You see where I'm going here? Mind you, 64% of Americans live paycheck to paycheck. 64% of Americans. This is at the end of 2022, they took a survey. That's up from 61% a year before. And half of the people that make over six figures, that's $100,000 or more. So most people would say $100,000 is a lot of money until you have a family. But most people that have $100,000 are complaining that they're stretched too thin. And this was never the case before COVID. So think about that. Record high debts. Most of your money is in your equity of your real estate. Inflation's going up. The Federal Reserve must raise interest rates. As Federal Reserve raises interest rates, mortgage rates will go up. Current mortgage rates, if you actually go to the bank, is going to be somewhere around 7%. Not stated in actuality, high sixes. But now the mortgage rates are probably going to go up to 7.5% and 8%. When that happens, guess what happens to real estate prices? Boom. And when that happens and people only have paycheck to paycheck, they don't have any catastrophe, lines, and they can't borrow anymore because they're up to the freaking gills with debt from the banks, from the credit cards, auto loans. Guess what happens? This is when our whole economy is. Let's keep going with some more charts. The blue is our household debt, and the red is everything not household. This includes credit card debt, auto loans, things like that. So most of our money is, in fact, in our house. This is a very good report right here. This report is from LendingTree. A lot of their information is based on that Federal Reserve sheet that I just showed you. This is what I wanted to show you right here, just to chart it. I want you guys to see a chart to make it very easy. This is debt. This is not your car payments. This is not your house. This is just straight up debt, okay? This is your credit card debt. Look at that. Look at that, like, vicious whiplash. Right here, down. This is before COVID, down, and boom. But look how long it took. Look, this is 2008 right here. Look how long it took from 2008 all the way to 2019 just to surpass 2008, right? This is 2019. So it literally took 10 years plus for you to surpass the credit card debt from pre-last crash. But now look at this. You went from the end of 2019 to literally 3 years later, and you already surpassed the debt. And look at the vicious line. So this line is this angle. But if you go to our current line, it's like this. Look how freaking vicious it is. And this is just from 2008. This is the same thing I just showed you, but zoomed in. Look how absolutely vicious this is. This is absolutely destructive. And we're about to hit this point right here. This point right here of 1 trillion. You know what's going to happen, right? This is so freaking aggressive. Be very, very careful, guys. Be so careful. People don't realize, like, you think everything's all good. Everything's good until it's not good. Be very, very careful. Shout out to my man, Mr. N. I don't want to give you his full name. He went to go get 2 side jobs during this down market. 2 side jobs so he can dollar cost average into crypto. He dollar cost averages into stocks. Shout out to him. 2 side jobs he got on top of his regular job. During the Super Bowl, he was doing DoorDash just to make extra money. Shout out to him. Shout out to him. Guys, be very, very careful. Stop spending money as much as you can. And if you have money on the sidelines, make your plays very smart. Don't live in this freaking euphoria. This is the whole country, guys. How much debt? Let me ask you guys a question. How much average national debt do you think we have? If you were to guess, how much is the average national debt a household has on credit cards? What would your guess be? I'm curious. So this is a map of the United States. Average credit card debt. Connecticut, 9,400. New York, 9,200. Kentucky is the cheapest, 5,400. Guys, 5,400. And the national debt is like 6,000. Dark green is the heaviest debt. Light green is the lightest. Did you hear what I just said? Most houses' debt is like 6,000 something dollars. 6,000 freaking something dollars in debt. Go to the housing market. This is very, very important. Existing home sales descended 0.7% in January. This is, by the way, from the National Retailers Association. This just came out 2 days ago on the 21st of February. Existing home sales waned for the 12th consecutive month to a seasonally adjusted annual rate of 4 million. Sales dropped 0.7% from December and 36.9% from the previous year. However, the median existing home sales increased 1.3% from a year ago. Let's think about this. Home sales are declining for the last 12 months and even year over year. So month over month, year over year. But the prices of homes are pretty steady and a little bit up. Let that sink in. What does that show you? That shows you that there's a huge disconnect between sellers and buyers, okay? Sellers want to get premium dollars still, and buyers want to get a deal. And the problem is people are putting houses for sale, but nobody's buying it. For now. Let me ask you what's going to happen if the interest rates go up 1%. For every $100,000 that you have to borrow, if the interest rate goes up 1%, you have to pay an extra $100 a month, for example. Think about that. With an average home being $400-something thousand, just think about that number. You're going to have to make around $350 more for your house payments for every 1%. What's going to happen to the chart that I just showed you? Think about it. The average price of a home is staying steady. However, homes are staying on the market longer. They're not selling. As people are going to be able to afford less, eventually people must drop the price in order to sell. And if they drop the price in order to sell, what do you think is going to happen to this? Remember this? You remember this chart? Housing debt, $12 trillion. This is your mortgages, which means if your mortgages is $12 trillion, it's fair to assume that the actual equity is 4 times this. If your mortgages, your down payment is 20%, right? I'm sorry, I made a mistake on that. The equity in your home is a fraction of this amount. So as they're going to raise interest rates and people are going to be able to afford less, you owe money on your house. If your house's value goes down, you can possibly be underwater, which means you owe more money for your house than your house is worth, which then goes pop, housing bust. It's a very, very scary time, guys. It's an extremely, extremely scary time when it comes to everything. Now let's talk about Treasury bond yields. This is a 10-year, this is a 2-year, and this is a 6-month. The current interest rate for a 10-year Treasury is 3.9%. That means that every year you're going to get from the government 3.9%. I think they pay you semi-annually, twice a year, if you lock up your money for 10 years, and then you get your initial investment back after 10 years. However, for 2 years, you would be getting 4.8%. It's interesting because usually if you invest for a longer time, you would think you would get more money. But in 2 years, you're getting 4.8% versus the 10-year, that is 4%. Let's just call it 4%. Why? Why is the 2-year more than the 10-year? Just think about it. Think about it. Why? Logically. The reason why a 10-year is less than a 2-year, because we believe that in 10 years, the inflation is going to go down. Why is the inflation going to go down? Recession. Don't believe me? Remember the chart that I showed you in the beginning? how spending went all the way down during coronavirus, which was a recession, naturally or not naturally, it was a recession. The way we get inflation down is reducing spending. The best way to reduce spending is a recession. The market is counting in that there's going to be a recession. That's what those numbers mean. Will it happen? I don't know, guys. I'm not trying to fairmonger you, none of this. I'm just giving you guys some information. Now, let me show you one other thing. Guys, this is the 6 month. This is the 6 month. 5%. I'm going to be buying this very soon. What does this tell you? This tells you that they don't believe that the recession is going to happen in the next 6 months. They believe that they're going to keep raising interest rates, the Federal Reserve. Probably we're going to have a recession. Probably, if I had to throw a number there, 2024, not 2023. Because everything is lagging. It takes time. Now, I'm not a genius or anything. I don't presume to know any of this. So take everything I'm saying with a grain of salt. I'm just a Jewish kid from Brooklyn, you know? Be very careful with what's happening right now. The market is starting to price in that there's going to be a recession. Be very, very careful. Now, unlike a lot of YouTubers, these geniuses who never made money outside of YouTube, who show you a chart and they're like, oh my God, PCE. Yeah, I got thumbnails like that too. But I'm going to go over all the things. So now we went over personal spending, inflation for the consumer, inflation for the wholesaler. Those all are going up. We went over market sentiment, that the market is betting now 35% chance that the Federal Reserve is going to raise 50 basis points, not 25. That in of itself is going to drop the entire market. Think about what? Seriously, think about it. The market is now 35% that they're going to do 50 basis points. My last live, that number was 0. It was like 0.1. Think about it. The Federal Reserve will have to keep raising rates. As they have to keep raising rates, mortgage rates must go up. As mortgage rates must go up, inflation, interest rates on credit cards also up. People already up to the gills with borrowing. They have no more money to borrow. As rates go up for your mortgage, home values will drop. Naturally, this is organic. You can't do anything about it. If you can't afford something, you cannot buy it. If you cannot buy this, eventually the price of this goes down. That's the way it works. This is the natural order of things. It's not rocket science. It's not, brain surgery. This is the way it works. If you can't afford this for $100, will you buy it for 99, 98, 97? Eventually, we're going to come up to a 50 cent or dollar, whatever you want to pay for this. And the Federal Reserve is not going to make it any easier by raising interest rates. And as 64% of Americans are living paycheck to paycheck, screwed. Most Americans will never own a house. Most Americans will never own a house. Screwed. So now when prices of houses are going to go down in places like Kentucky where you can buy a house for like $50K, I'm going to go buy it for cash because I don't need a mortgage. And when I come up to somebody, I'm going to say, hey, you want $50K? I'll give you $40K because I have cash and I can afford it. Something like this. I'm giving you just an example. I want to show you now the Treasury bills. This is the website for Treasury bills, Treasury Direct. This is if you're buying short term. So these are not Treasury bonds. Treasury bills, I believe, are 2 years and less. It doesn't matter. They're all the same. I want to just explain one thing. If you're in a state that has taxes, the 41 unfortunate states that have taxes, if you buy Treasury bonds, bills, notes, there is no state taxation. No state taxation. So you would be getting right now 5% interest for the year if you lock it up for 6 months. That's not bad. If you take this divided by 2, because it's 6 months, it's not 12 months, dude, you would be getting a safe 2.6%. This is safe. This is as safe as you can be. This is you putting the money in the United States government. You are believing that the United States government is going to pay you back your percentage. Guys, that's safe money. Everybody's investing in dividends and ETFs. This is safe 100% money, not financial advice. Go to this website. You guys can buy it yourself. No need to pay a broker. Don't buy an ETF. Buy it directly. Not advice. Do whatever you guys want to do. Treasury Direct. National debt. The cap was 31.4 trillion. We will be raising the national debt. If you guys don't know what this number is, this is how much money the United States owes. The problem is this number right here, 120%, is the number that we pay for the money that we have. What does that mean? We owe 31.57 trillion and we bring in money. For every dollar that we bring in gross domestic product, we owe $1.20. So let me just rephrase that. The United States is not living paycheck to paycheck. The United States is broke. Let me repeat that one more time. The United States of America is broke. We owe more money than we make. We can never pay back the money that we owe. Therefore, we keep raising borrowing. If you were the United States government, you would be without a house, a car, a loved one, and family because you would be a bum. The United States government is a bum when it comes to finances. And that's a fact. I'm not making this up. This is a fact. And anybody that tracks this will tell you the same. However, they're still doing better than most other countries. And they're not the only countries that are bums that cannot possibly pay back. I'm not making this up. The United States government cannot pay back their debt. And as the Federal Reserve raises interest rates, the U.S. government has to pay more money in interest. And that 120% actually goes up. At one point, it was 135% as our GDP was going down during Corona, which means for every dollar that we brought in, we needed to pay $1.35. Let that sink in, guys. The United States is broke. Let that sink in. This is a chart for cryptocurrency, guys. For the longest time, Bitcoin was immune. And I'm saying, when I say Bitcoin, I mean crypto. Bitcoin was immune from stock market. Bitcoin had this run up. Bitcoin is blue, stock market is gold. Stock market was going straight, and I'm comparing it to the NASDAQ, okay? QQQ, which is the tech sector, more or less. For the longest time, the stock market was going just straight, right? Like normal path. And the crypto market was like boom, 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 volatile. And somewhere right around here in 2020, 2021, 22, like right around here, it all of a sudden started acting the same. You see like this, kind of like this point right here, right? You see how you have it? And then it starts to correlate better. Now, if you're going to go to 6 months, there started to be a correlation. What I want to bring up is this right here. Let me zoom out so it's just a little fairer. 1 second. Do you see that there's stopping to be a correlation in the last couple of months? You see, this is the correlation, but it looks like it's stopping. It looks like Bitcoin possibly can be breaking away from the stock market. So this is going to be a very, very interesting situation right now when it comes to cryptocurrency, when it comes to Bitcoin, when it comes to stocks. Because for the longest time, the crypto bros, including myself, I'm a crypto bro, were like, we were a hedge against inflation, but we weren't because of all the greed of institutional investors. I believe a lot of institutional investors got out of cryptocurrency. There's still significantly more institutional investors than retail. However, something is being shaken up, and now I only have the data for a very limited amount of time, but it does seem, and anybody that's in crypto will tell you this, that crypto is starting to break off of stocks. If that happens, maybe, just maybe, crypto takes off as the stock market goes down. Think about it. Think about it. That's what always used to happen. Crypto was a hedge against the stocks, right? Whatever's bad for the economy is good for crypto. Whatever's good for the economy is bad for crypto. But that changed. And all of a sudden, over the last month, I'm starting to notice a little bit of a difference. Also, one more thing. Home Depot came out with their earnings and so did Walmart. Home Depot missed earnings for the first time in years. Home Depot says that their guidance for the next year is going to be flat. Where does Home Depot make their money? Construction. What is construction for? Real estate, which means people are not building new homes. So keep that in mind. Guys, I really appreciate it. Now I will open it up for any comments if you guys want to ask. And if you guys want to ask me how to support my channel, I do have channel membership. It's $3 a month. You don't get anything special but a badge next to your name. So I appreciate you. And you get really cool emojis that you can use. For any of my channel members, guys, I updated the emojis. Feel free to use them when we're chatting.